Hi, I'm Jimmy. In this video, we're going to walk through a quick review of where the US economy stands. We're using different economic indicators to see if we can objectively gauge where the US economy stands today. The goal is to see if we can get enough of a big picture view of the overall economy, trying to help us determine should we invest now or wait for the stock market to crash. And ideally, this will help us make a better investment decision and get us closer to our goal of achieving financial freedom. Okay, so let's jump in. So I'm going to try to use the same economic indicators as we did last month so we can get a better way to compare one analysis to another. So if you know of any good leading economic indicators that I don't review in this video, please put them in the comments below so I could try to incorporate them into the next video. Okay, so first up, we've got the S&P 500. Now, I'm not going to use this on our economic scorecard. I just wanted to illustrate how well the stock market's been doing recently. And I also want to point out this hesitation here in the past month or two. And as we could guess, this is largely due to the reaction from the coronavirus. Now, I think it's worth noting and probably obvious that the coronavirus has had a bigger impact on the Chinese stock market. This is the Shanghai Stock Exchange Index. And clearly, they've had a big dip recently, although it does look like they've had a decent bounce off of the bottom. So clearly, the coronavirus is something we're going to want to watch, as it's always possible that some sort of black swan event like this could be the reason that the first world economic domino were to start falling. It could be the initial cause of the falling of all of the different major economies. So I think it's important that we acknowledge that this is out there. This is a big potential negative. So this is something we're going to want to watch. The longer this drags out, the bigger the potential problem we could have. Okay, now let's jump to our first indicator. First up, we have the yield curve, or more exactly, the inverted yield curve. So this is the inverted yield curve. This is the yield curve when it inverted just a few weeks ago at the end of January. Now, we know this yield curve is inverted because the short-term interest rates are higher than the long-term interest rates. In this case, we have the 3-month is higher than both the 5-year and the 10-year interest rates. And this is a bad thing. This is a bad sign for the overall economy. This is clearly going to be a point for the bears, since historically, all recessions in the United States have been preceded by an inverted yield curve. And this isn't the only example of an inversion of the yield curve that we've seen. We had a few of them happen last year. So clearly, the inverted yield curve is something that is looming over the United States or the US economy, and this could be a bad sign in the not too distant future. So when we jump over to our economic scorecard, well, right now the bears get 1 point for the inversion of the yield curve. Next up, we have manufacturing. Now, this is the ISM manufacturing PMI indicator, and this has clearly been a negative point for the bears since about the second half of 2019, when it was this fall that we were watching. As we were watching that fall, we became more wary of it. And then in the past couple months, well, when the manufacturing index fell below the 50 level, this became a real problem. 50 is an important level for this indicator because anything below 50 implies negative growth in the manufacturing sector. Anything above 50, even when it was falling, implied that growth was slowing, but it wasn't negative until it dropped below 50. But clearly, we can see that in January, the number jumped back above the 50 level. Now, I don't want to overreact to this too soon. I wouldn't want to call this a positive sign because we've had 1 month where it's been above it. But the fact that there's now, again, growth in the manufacturing sector could be a good thing. So I think it makes the most sense when we switch back to the scorecard to give this one a neutral point, because as of right now, I think it's too soon to say it's a positive, but at least it stopped falling. And not only did it stop falling, the sector started growing again. So overall, I think we got to give a neutral point for this one. 1 point for the bull and the bears. This is going to be an important one for us to watch over the next few months. Okay, next up, we have 2 indicators on a way we can track how late consumers are as far as their payments. How late are they with their payments on some big purchases? First, we have auto loans. So as we can see with this chart, we can see that there's a larger percentage of people that are 90 days or more late on their auto loans. Now, this indicator is updated quarterly, so December is the last number that we have. But the fact that more people are late on their auto loans is clearly a bad thing, and this is going to be a point for the bears. Then when we switch this chart over to the percentage of people 90 days or more late on their mortgages, well, much to my surprise, this held up a lot better than I would have expected. Sure, there was a slight uptick in the past quarter or two, but nothing too significant relative to how bad it got in the wake of the Great Recession. So overall, when we jump back to the scorecard, well, with these two, I think it makes sense to give a point to the Bears for the auto loans. Clearly, that's a negative sign. But for the mortgages, I think it makes sense to give them a point to the Bulls, since mortgages are doing pretty good right now. At least they're not too late on their mortgages, which makes sense. You're more likely to pay your mortgage than you are your car if you're running into financial trouble, assuming you could afford it. Okay, now we're jumping over to consumer confidence. Now, consumer confidence has been a point for the Bulls for a while. And if we look at the most recent numbers, the January numbers, well, they came in right near the highs for the consumer confidence. So overall, the fact that consumer confidence is sticking up this high is likely to be a good sign for consumers in general. And maybe if we were to think about this from the mortgage perspective, I guess in hindsight, consumer confidence numbers being good as they have been for a while now, well, I guess it would make sense that if more people were being late on their mortgages, then I'm guessing consumer confidence would fall. So these numbers are likely to be tied to each other. So I probably shouldn't have been surprised that mortgages were doing okay, which explains why consumers, broadly speaking, are fairly confident. Okay, so on our scorecard, we got a bullish point for the consumer confidence. Okay, now we're sliding down to a similar economic indicator in CEO confidence. Now, much like consumer confidence, CEO confidence has proven to be a decent economic indicator as far as predicting what's to come in the economy. And I was torn with this particular chart. Clearly, relative to the Great Recession, it's looking pretty good. But the last time I did this video, I actually gave it a point to the Bears, since over the past year, it has been trending lower. Now, if we were to zoom into that part a little bit, well, we can see that the January number came out, and it's possible that CEO confidence, it looks to be right at the higher end of that trend lower, but it's possible it breaks higher. But once again, I think it makes sense to stick with a point for the Bears, since the fact that CEO confidence seems to be trending lower over the past year, to me would, it's a warning sign. It's something that we should be watching. So right now, I want to stick with it with a point for the Bears, but let me know if you would do it differently. Okay, now we're jumping over to housing starts. Clearly, this economic indicator looks good, as many new houses seem to be being built. And clearly, we saw a spike in this indicator very recently. Now, the theory behind housing starts being a good thing for the economy is that more people buy houses when more people are confident in the overall economy. The more people that buy houses, the more houses that they build. That's how you get this number moving higher. So on the scorecard, clearly that's a point for the Bulls. Now, when we're looking at the scorecard, it's not too far off this month than it was last month. It's split about 50-50 right now. And I think that's a fair assessment of the economy. It's very possible. We're in an election year right now. It's very possible this thing runs for all of 2020. Perhaps we have a pullback in 2021, and there's enough warning signs that something could be around the corner. Overall, I'd say that I'm fairly confident with the economy, and I think it makes sense to continue to invest our money as consistently as possible. I'm a big fan of dollar cost averaging, and I think that if I had a choice of investing now or waiting, well, as I've said for the past year, I think it continues to make sense to continue to invest, albeit defensively. I think there's enough warning signs that it makes sense to stay defensive. Now, I have been asked a few times, does this type of economic analysis really work? And just recently, I did a video on where I went back to the Great Recession, right at the peak, right before the Great Recession happened. And I did this same type of analysis with these very same indicators, and I wanted to see whether or not this would actually work. This is what that video was. If you're curious, this could be a good next video to watch. If you're curious what it would have looked like before the Great Recession, would we really have had warning that the S&P was about to tank? If you're curious, there's a link here. There's a link in the description below. And I want to thank you for sticking with me all the way into the video. I really appreciate it. I'll see you in the next video.